This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Andrew Joseph, who is no stranger to our Trigger Webzine subscribers, and our 4 times a week technical market alert updates. Andrew is the principal of Golden Phi. He's the publisher of Trigger's Media Publications, Inc., and editor of the Trigger's Webzine and website. Good morning, Andrew, and welcome back to Macro Analytics.
Morning, Gord. Thanks for having me back.
Andrew, I want to get right into the slides so we have time for them, but I need to just take care of some mechanics before we do. I would ask our listeners to open the slides to full screen viewing. You need to open the slides to full screen viewing to properly see the detail we'll be discussing on some of these slides. There is an icon in the bottom right-hand corner that by clicking it will do exactly that. I need to be very clear that the slides this morning are for educational and discussion purposes only. They are not to be used for trading, nor are they in any way investment advice. They are solely for our discussion purposes here this morning. Andrew, what I hope we could cover this morning is shown here on this slide of just the highlight points. I'd like to revisit the IDES of March article that we put out in the last Triggers webzine, and also put out in part another version of it in the public domain. It relates to the second point here of what's happening with the amount of money printing and this unprecedented monetary expansion that's going on. The continually growing technical divergences that we've had for months, but they're just continuing to get worse. The 2013 earnings, what we see for Q1, but for 2013 overall, I see an earnings recession on the horizon as they've been steadily decaying. We'll show that. Corporate cash levels are at an all-time high, and what I expect them to do with the cash. And by the way, cash flows are slowing significantly as measured by EBITDA and EBIT ratios, which affects enterprise value and intrinsic values, something people are not paying enough attention to. And also, hopefully I have time to talk about the message that the gold market's sending, and gold specifically. I think it's starting to tell us some very interesting things that are going to happen in second half this year from a global central banking position. So pretty aggressive. Hopefully we can get through these. Andrew, the first slide here is the one that we had in Triggers, and this was our target when we put it out, that we thought we would be looking for 1562 on the S&P 500. At the time, we were a little short of the 1515 mark, but we felt that somewhere in there we would get a retracement. We did get that retracement, but not anywhere near the degree that we thought it would be. It was a pretty shallow one that we got. I have the chart up here now that shows where we are today, and you can see though the retracement we had was a little shallower, as I said, but we've been marching pretty well steadily to our goal, both on time, the Ides of March, which is the quadruple witch for the month, and on price. I have up your chart, Andrew, from the yesterday on the S&P with the high probability trading zones reflecting the targets. Any comments on it?
Oh, yeah. Well, we can see the short pullback that you discussed there in our February issue. The circle, the ellipse there that the market comes down to, we had it as a target. And we also had subsequently added the target below that, which what we were just talking about in the Ides of March, that we just didn't quite come down to. But then obviously we have the lift from there that we've been expecting, and it seems to have shot right up to our next high probability target zone, which again we had given at the beginning of February is where we were looking at one of the places for this to go to. And this lift probably isn't over yet either. If we take a quick look at the next chart, we'll see that the count here may be looking at a 5. And currently, as we talk, we're in the 4th wave of that and expecting another 5th. And we'll see how far up that goes. We can see we're almost at the October 2007 market all-time highs. And so the fifth may end or push through that. Well, still waiting to see what happens.
The fact that we were a little shallower, shown on the bottom left here, and we didn't quite get down to the green box. Nevertheless, it was a Fibonacci retracement, but it wasn't the full 38.2 that we typically speak. When that happens and it goes a little shallower, it usually means the extension is more aggressive. And that's what we're having. So it's happening very, very quickly, pushing very strongly towards our target. So I think we've got the pattern right. We always say we may not get the exact path, but we always get the end target zone. Do you explain that, the high probability trading zone, these green boxes specifically?
Yeah, these are areas chosen because of the technical analysis, and there's usually quite a number of reasons why they're chosen, but majorly because of the confluence of the technicals that are coming together and where they're lining up across other markets as well. In the current count here, we can see that we've hit one, and we'll probably hit the next one up too. The count for the first wave is smaller than the third wave. When this third wave ends here, we can see it's a larger than the first, and so we could expect the fifth wave to possibly be even larger again, which means we'll go through our next target and probably make new all-time highs. And then the levels up there, we'll be looking at some Fibonacci extensions because we don't really have anything prior to base anything future on other than extensions.
One of the things that's really noticeably different is the U.S. dollar. And I have up your U.S. dollar chart from the latest Triggers daily updates. Comment on it?
Yeah, I brought it up specifically because we're seeing a little bit of disconnect here. Obviously, you can see that there's a huge spike in the U.S. dollar. It's just been driving up dramatically. However, at the same time, we've also had, as we've just seen in the charts, that the SPX is also lifting. And I wanted to bring this to your attention, Gord, and maybe get you to comment on some of it, because we usually have an inverse relationship. And right now that's not happening. They're both lifting together.
It's so highly unusual, isn't it? You have not seen this in a long time.
And despite the spike, you can see all the little red boxes that I've marked on there that are high probability target zones have been, again, on the U.S. dollar hitting, just as we have been on the SPX.
What the chart is, one, it immediately tells you how delusional and distorted the markets are when you see this, because as the dollar strengthens, it means, in fact, you can buy more stocks with it. So the stocks always go down. So why would this be? And what it is you have a fear trade that's going on, Andrew. And by fear trade, with the currency wars, there's this flight to protect assets. I think the U.S. dollar is the worst asset to hold your money in, but having said that, it will be the last to fall. And so it's the worst of the lot, but it's the best at the party. So the money is still flowing into the United States dollar. There's a concern, very much a concern of the markets and the securities markets of a significant correction. So it's flooding into the U.S. dollar. So that's the strength in the U.S. dollar. Now you say, well, Gord, why is the market still going up? That's a slightly different argument. Because if you look at the volumes, Andrew, there's no volume in the stock market. I mean, we're down well below the 2007 level, still falling down dramatically. So who's buying the stock market if there's no volumes? And there we get into the high frequency traders and the games that are being played. And you see it in the spikes that we, right at the end of the day or at the market open, that happen in the middle of the night, at huge moves on no volume. So the markets are clearly reflecting the amount of money that's being printed, but not necessarily put to use, but being applied. And that's coming out of the derivatives and the options market. One other thing that's telling to me, Andrew, is though the volumes are down, and you see that in this particular chart here at the bottom, the on-balance volumes are actually breaking out a little higher. And I won't get into a whole explanation on OBV, but it does mean there's a correction coming. But this could push out just a little bit longer. This could drag out through the April, and we talked about this before, April 15th, tax money submitted. Remember, you may recall, Andrew, when the dot-com collapse happened in April, it wasn't until all that money was put into RSPs and IRAs for the market then started to weaken. So we could drag it out a little bit, a little coiling before we start to see a correction and a fairly significant consolidation happening, which we've been calling for some time now. This chart I have up, I just got from Merrill Lynch, the Global Research Department. I was pretty pleased when I saw it because for the very first time they're starting to reflect exactly what we've been saying here, Andrew, for months now. where the target is, where the upper resistance is, 1565, 1575. It could be just a touch higher than that right now, to be honest, but they're showing that. But the corrections of where they see it starting to retrace back to. So everybody's starting to consolidate around those upper limits that we've had for a time, which is another way of saying that it probably is a good chance that that's when we're going to start to see a correction. This will be an intermediate top, but it's not the final top. And we'll talk about that a little bit later on. I want to switch gears, Andrew, to monetary, and then we'll come back to these charts to help explain the anomalies we're seeing. This shows you that clearly the growth of the monetary base, that is the Federal Reserve's printing of money, pushing out the credit, has been mapping with the S&P pretty consistently. But there's some alarming things that are happening behind it. And this chart goes back a number of years and is showing consolidated all of the central banks up there in the top left-hand corner, the Bank of Japan, the Federal Reserve, the Bank of China, ECB, Bank of England, and the Swiss Bank. So that the rate in orange is showing the rate at which the money's being pumped out into in this case, their balance sheets. And it's been up fairly dramatically. What it shows is also the rate at which they're increasing it. Yes, it's increasing, but it's not a consistent rate. And the blue line shows you that every time that they start to slow with the rate of increase, your second derivative, for those that remember their calculus, you immediately you'll see that the market weakens quite noticeably. And so the point that this chart is showing that they have to keep continuously not only printing money, but they have to print it at a higher rate, larger amount, and a shorter duration. And so the red circles, or the circles here, are showing that when we get down close to the zero line, in fact, what we're then having is a deceleration in numbers, because you can see the 5 and the -5 over in the bottom right-hand corner. That's when they've been forced to act and act aggressively. So it's suggesting to me that not imminently, but certainly as we get into no sooner than June, but July, August, September, there's a coordinated central bank action that's going to be significant. I mean, it looks to be dramatic. So we're not talking about the Federal Reserve increasing their balance sheet from $3 trillion to $4 trillion, which is the current expectations. I believe that is priced into the market. It's been one of the factors that's been driving this rally. But when the market corrects and begins to correct, that we see coming here in the April time frame, could be into May, but somewhere in there, as it corrects and the fear comes in, and I think there'll be a fear in the bond market, specifically on rates, it will then give the central banks the cover to make the next step. And this will be dramatic. And you could see the whole monetization of public debt. The same thing that Japan is now totally and absolutely threatening to do. They're now talking about this with trial balloons in the ECB, and I've done a number of tapes explaining and showing that in the macro analytics series. So I'm trying to show pictures here of near term. There's going to be some significant weakness. There's going to be fear, but there's another round coming out of the central banks. I don't think they want to play it, Andrew. I don't think they want to do it, but I think they got no choice and they're going to be forced to do it. And the gold charts are reflecting that. This is the Dow. Right now, we've got 5 Dow stocks that have been just driving the market. You've got 10 S&Ps that are 20% of the S&P, but they're starting to flatten. And where I'm showing problems is those had been driving the market. They've flattened out. The other ones have picked up, not recently, but had been riding that wave. And but they're a smaller mark, so it's starting to roll over. And the reason it's rolling over is you can see it here on the margins. The margins have peaked. The sales have peaked. The top line growth has peaked. There's not much more that they can squeeze. And if you see the profit margins, we're at all-time high profit margins. But on the right-hand side, you can see that the labor content has been so low that personal income, disposable income, is being crushed. And, when you have a weak consumer in a 70% consumption economy like the United States, it's got to impact earnings at some point. And now we're seeing that. And I think that as we get into second half, we're going to start to see an earnings recession. And certainly we're on the verge of a recession anyway. We're already there in Europe. We're there in the UK. And a lot of the Asian countries are right on the border of that. So when that happens, that's part of the fear that I'm talking about. The market right now is expecting this. They're expecting earnings to go through the roof on the right-hand side. There's not a hope there's not a chance of this happening, Andrew, in my estimation. But that's what's priced in. You've got to believe that that's going to happen for these current earnings or these current projections. The corporations themselves are sitting on huge amounts of cash and are still going out and borrowing to get more cash, but they're not investing it. They're not putting it into capital expenditures. That is top-line growth. They're hunkered down. They don't see the opportunities and they've got the cash, but their rate of growing their cash is shrinking at a significant rate, which impacts earnings and valuations. And so, but I think they're going to start to, my personal opinion, is increase buybacks, which this is showing the dramatic increase in the amount of buybacks that are now starting to happen, and dividends. They'll do that to be able to shore up their prices of their stock. Because remember, if you've got a lot of cash sitting on your books, you're a takeover candidate. And so if your stock starts to get crushed, you want to be able to not only protect your company, but be able to make acquisitions. So you'll see them trying to drive it up their stock value with dividends and cash payouts, but also having the cash available because they're holding huge amounts offshore to come in on a correction to be able to take over other companies. So I think that the corporations are sending a pretty clear signal in my mind. This is the gold chart that I mentioned earlier, and that's a pretty standard consolidation pattern, is it not, Andrew?
Yeah, it's a very common wedge we see.
You know, that basically is showing an A, B, C, D, E, but blue line shows where we're at right now. So we should, maybe there's a little bit more in gold, but we'll get a bounce in gold and then should go up to the red line and come on down. And that ties into this concern in the market, sell off in the market, more money printing with the Federal Reserve or the banks, but then this great reflation that I referred to in the second half, where the Fed, the central banks really have to do something dramatic that's showing up in the other charts. And the gold chart saying if this is classic ABC consolidation, then in fact that would be a lift and a significant breakout in gold, which ties in if we really start to debase currencies, there'll be that kind of liftoff in hard currencies. And gold reflecting it. So you can never be sure, but I won't bore you with all of the charts that I put out in the MATA document this month, but they're pretty consistent right across the board. And that's the beginnings of what people are anticipating, the smart money starting to position as this as being a fairly high probability. Any comments on gold at all, Andrew, you'd like to make?
Yeah, we've been watching it for a while, and obviously our charts show the same thing. When we get down to a finer granular aspect, a lot of support right now, both with the channels. There's also a major Fibonacci circle support that's coming into play. So we'll see if it does break. We could the next level of support is down at 1400s, but I don't see that happening.
I've been moving through the charts pretty quickly because we don't have a lot of time, but just to give everybody an overview of what the high probability is right now. This kind of summarizes it. We got a little bit more up to go, and then we have a drop. And that's what that arrow is showing, is the drop down. And this is the fear that I'm anticipating that's going to happen April, May, June kind of time frame. And then when the Fed and the central banks do take their action in second half, then in fact we have this lift up to test the top. It may be a little short of the top. It may be a double top. It might possibly be a slightly higher top, but it's not going to be significantly off the current top that we will make here later this month that we talked about previously. Something in the 1565, 1585 on the S&P 500. But it's going to be a scare, a reaction, and then we begin when, frankly, the belief in the Federal Reserve, the central banks, their omnipotence is destroyed, and we realize that in fact the king didn't have any clothes, and that's what we've got, because monetary policy is not it is the problem, but it's not the solution. And right now the only tool we're using is monetary policy, and that's only a matter of time before it'll fail. Andrew, I put up this chart here with a series that I did with Charles Hugh Smith, and he'd written a very good article on the global endgame in 14 points, and we mapped out the points of. And I encourage our listeners to read the article and some of the tapes we did on it. But there's a standard cycle that we go through. And the industrial age, we had it on the left-hand side. and stages that are consistent that we had, and I've mapped it out where even down to the point where you can expect to see currency wars, and it's shown up here in beggar thy neighbor. But now in this new financialization age and in a fiat regime where we have fiat currencies, it's changed. And that's what Charles was mapping out in his article, and I've mapped out here in this particular set of charts of how that starts to interplay. And the bottom line is that we should be having massive plant closings. We should be having debt defaults, but we're not, because we're papering them over with cheap money, low interest rates. That works to defer it, but it doesn't fix the problem. And the problems get worse. The malinvestment, the mispricing gets worse, and that's what we've come to on a global basis. So until we have a market clearing event where pricing power can be restored, the natural cycle and the natural order of how capitalism works is being pushed out and distorted. And this chart here shows that, in that cycle at the bottom, that's when the creative destruction, the destruction of malinvestment happens. But we don't want it to happen. And unless we can reinvent the whole capitalist system, and the central banks and the politicians know how to do it, when it does break, it's going to get very, very ugly. And that's that right-hand side of the ellipse chart that we've shown here previously. A lot of charts, a lot of information very quickly, Andrew, but we're right up on time here on our hard line. Any comments you'd like to make on anything I've shown here this morning?
Yeah, I'd just like to mention that everything that we've gone through here today with respect to your presentation and so why we're seeing what we're seeing, Triggers takes that and we try and bring that down to the level for the traders to use and reflected in our charts, the high probability target zones that we've been talking about earlier. Some of those reasons that they're chosen has to do with your analysis here that we're showing today as to what's going to be happening and what's going on. We've been pretty effective in getting those with about a 90% accuracy on where the market's going to be moving to. And we bring these charts down into a daily and an hourly level for intraday subscribers.
Andrew, could you make some comments on the high probability trading zones, the accuracy that you've been getting on those, and where people could see the statistics for it?
Yeah, they can find the statistics on our site itself. I keep those update, as well as when they sign up for a 2-week free trial, which they can do. Statistics are in the market updates that they'll receive with those as well. But it's around 92% that we're getting. Again, with the methodology, whether the market moves up or down, they are moving to these places where through our method that we have the technicals aligning up. They show very clearly where the next level of the movement should be, and as well, not just the level, but the time period it should happen in.
We like to keep these tapes to 20 minutes. We went a little over them, and I apologize for going through some of these charts so very, very quickly, but there's a lot of information. We like to try and cover it, but we have to do it maybe a little too quickly. But for those that are interested, sign up for a trial at Triggers, sign up for a trial at the Mata on my site at GordonTLong.com, and see a lot of the detail that goes behind some and many of the other charts analysis that we do. So, Andrew, talk to you again next month.
Thank you, Gordon. Take care.
Talk to you. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.